Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, we're going to jump right back in. I want to try to get through some more here with you on how to construct a portfolio, how to, in fact, have the stock market work to your advantage. All right, so let's take a look at myth 2, track record investing. All right, what we're looking at here is that with mutual fund companies, and I used to do this, I would, when I was in the broker-dealer system, I would look at what my broker-dealer put out there as far as what was called the proven performer list of mutual funds, and I would get so frustrated because I would be looking at these funds and these are supposed to be working and they're not working. They're underperforming the market. So I then started constructing my own portfolios, and I was the same thing. I would look at the mutual funds that had done the best over the last, 1, 3, 5, 10-year periods, and I would pick those funds and I would say, okay, now I put my portfolios together for my clients, and guess what? They then underperformed the market. Again, I would get so frustrated. Why is this happening? So this is what happens with the second myth, all right, is that there is no correlation to a manager's ability to beat the market just because they did in the past. All right, and this is one of those areas. It's great if you knew it ahead of time. And let's take a look at the actual research on this on the next slide. When you look at track record investing with U.S. equity funds, here's what we find. If you look at the top 30 U.S. equity funds, the average return from 1996 through 2005. So we're looking at a 10-year period here. And what was the average return? 18.72%. Compare that to the S&P at 10.7, you're thinking, wow, this is wonderful, all right? I'm going to invest with these guys because they just beat the market handily, almost double what the market did. So I put my money into those funds, and what happens in the next 10-year period, those same top funds, 4.5% compared to the S&P at 9%. They got half the return of the market. And this is the problem. So we're trying to chase the ghost, if you will. I'm going out investing based on what they've done, and not only is there no correlation, but you can see it's almost a negative correlation. They almost always underperform the market after, and that puts me in a position of actually getting less. Had I just bought the market and stayed patient, I'm going to come out ahead. See, the only way that information is of any value if I knew in advance of when it was going to happen, right? And of course, we don't know that. No one has that crystal ball. So what we know then is that track record investing, or chasing after these funds, just doesn't work. In fact, if we look at the next slide, we'll see even a 5-year period from 2006 through 2010, average again of the top guys, 5.94% compared to the S&P at 5.16. So they outperform the market. That would be the one you'd be looking for. They beat the market. And then the next 5-year period, these top funds, 2.75% return, and the market went on a tear with an average return of 13.12% per year. All right. Again, we're better off. And by the way, if you look at the crisp average return when we're looking at the mutual fund or the portfolios that I was talking about before, you can see that does better than either of the others. So, all right. What we know is a manager's ability to pick stocks in the past has absolutely no correlation with their ability to do so consistently in the future. So what we know then again, how do we use that information? Well, first let's take a look at the next one, which is market timing. All right, this attempt to get in and out of the market. All right, so many times as a client said, well, I got a big return, so therefore I'm worried the market's going to drop. I don't want to lose this money I've just gained, so I said, I'm going to go in cash. And it may work, but it could go the other way too. The market, there were a lot of people that, a lot of volatility around the elections last year, around worrying about what the Fed was going to do with raising interest rates. And what happened, the market has just steamrolled through all of that, to everyone's surprise. No one expected it to do nearly that, or nearly do as phenomenally well as it has in that period. All right, so this is where if we'd have been worried about that and sat on the sidelines waiting for that entry period, that could have cost us money. All right, so we don't know really what's going to happen, do we? And the expectation is that the markets, again, over the long term, we know they're going to go up, but in the short term, trying to figure out when and what's going to happen is so difficult and impossible, in fact. So the goal is to have a plan that will allow us to do well no matter what the market does, and that's the key. All right, if we look at Dow Bar again, research study with regard to market timing, this is one of those areas that come in. The S&P 500 index, okay, when we look at it again over this 30-year period, averaged about 10.3%. The average investor, 3.66%. All right, if you look at inflation at 2.6, that means the average investor only made about 1% on their money. All right, and what are some of the reasons for that? All right, market timing is one of those that play into the role. So why does market timing doesn't work? Let's take a look at the next slide. If you look at a $10,000 investment, if you stayed invested, okay, now in particular when I say stay invested, if you are in an individual stock or a few stocks, a handful of stocks, a handful of mutual funds where you've got a lot of crossover in terms of holdings, your lack of diversification, you're not going to do as well as this. But let's just say, all right, that you've got, that we're looking at it from the market, an S&P 500, let's say you're fully invested, and you don't get out, you stay invested, then that 10,000 grows to about 50,000. All right, when we're looking at, this is the period from 1996 to 2015. All right, so about a 20-year period. Now look what happened though, if you missed just the 10, this is 5,040 trading days. The stock market was open 5,040 days over that period. If you missed just 10 days, okay, such a fraction of a percent of the time, you missed the 10 best days, and your return would have been less than half, or approximately half of what you would have got if you stayed fully invested. And if you miss 20 days, you can see it drops dramatically to about a third. And if you miss 30 days, you would have received very little growth on your money. In fact, you would have received virtually no growth on your money over that period. So it's so important to understand that to stay invested though, we have to be invested properly. Now here's another, beware of market timing. Tactical asset allocation. This is where with mutual funds, you'll hear many money managers all the time. I'll pull Morningstar analysis sheets and see where mutual funds are all of a sudden, it's like 6% in cash. And I'm like, what are they doing with so much cash? And when they're typically down around 1 or 2%. And one of the reasons that tells you that they're trying to time the market. They may switch around the assets, the stocks that they're owning for different reasons. Turnover ratio, we're going to get into this more as far as how it affects cost, but this is another area where we see it as an asset allocation or market timing, if you will, type of strategy. Market timing doesn't work. In fact, according to Dr. Ellis, Charles Ellis, who wrote the book Investment Policy, How to Win the Loser's Game, the evidence on investment managers' success with market timing, as he put it, is impressive and overwhelmingly negative. We know that market timing will cost you. All right, now myth number 4, the cost of investing. This is one of those that is very tricky because I see, again, I'm looking at portfolios all the time. In fact, I'm going to give another shout out. Here's the thing with portfolios. When people bring in their portfolios, their current investments, and we take a look and I dig down in and I show you analysis there with that client, I'm showing them basically the costs that are involved as well, the transaction costs, the hidden costs, in addition to the fees that are in their prospectuses or that they see on their statements. So again, cost of investing, extremely important. Understanding that and what these fees, there's commissions, there are transaction costs. So for instance, every time a stock is sold, all right, and if you look at a mutual fund and whether you're buying and selling stocks, you know there's a cost to that. There are commissions that are paid. There's also what's called a bid-ask spread. And what that means is simply this. If you look at what your selling price of a mutual fund at at a stock at say $49.50 and the buying price at $50, it's on the next slide. There we go. You can see that's a market maker. The market is going to make that spread in between. Now that's on a large company. If we look at the next slide, on large companies, that's not a large, that may not be as big a percentage. You can see on large companies, it's about 4 basis points, 100 basis points, of course, being 1%. But on small companies, you can get into as much as 1/3 of a percent. And if you're talking round trips where you're basically buying and selling stocks, you can all of a sudden see your costs go up dramatically. And this is one of the things, just how much can this affect when you're looking at your returns? Well, on the The bid-ask spread as a percent of price is an estimate of the actual trading cost. This is on the next slide. So this estimate is over 8 times as great as the smallest market segment. And if you're putting this together, all right, again, this can add up dramatically depending on the turnover. The higher the turnover ratio, the higher the cost. And when you're looking at a total expense, okay, we'll look at the next one, even on no-load mutual funds. This is, you see no load and you're thinking, oh good, I don't have that big sales charge of 4.75 or 5.75 up front. And that's true, but you still have active management where there's a lot of turnover, buying and selling going on. And again, remember Dr. Ellis, as he said, the key question is how much better the active manager has to be to recover the cost of active management, and the answer is daunting. In fact, when we look at the costs, we're talking about easily on these commission transaction costs, you could be talking 1.6%. If you add that to the average expense and fees within a no-load fund of 1%, an actively managed fund of 1.05%, you're talking 2.5%. In some instances, you may be talking, if there's a real high turnover ratio, 4 to 5% a year. That's a lot to overcome in a portfolio to try to get any kind of real return to stay ahead of investing. Is it any ahead of the market? Sorry. Is there any wonder rather where active management, why indexing will outperform that? And we're going to talk about how that works in a minute. But first, for the first 10 callers to my office, if you would like, in fact, to have an investment analysis of your investments to see how they stack up to what we're talking about this morning, as well as a comprehensive plan. We'll talk about Social Security, when the best time to take it is, how to maximize it, how to minimize taxes on it. Talk about your investment accounts, right? How to maximize your returns, minimize your risk. And how about this? When it comes time to take money out of them, how to minimize taxes on that as well, and the effects on Social Security and other taxes that you may pay based on those required minimum distributions or just the regular distributions you may take to maintain your standard of living. So again, first 10 callers, you'd like to get all that personalized for you at no charge, 615-376-5325. So again, first 10 callers, 615-376-5325. Tess is standing by. She'll get your information. She'll send you out a packet of things to bring to your appointment with me, a little checklist of items that you want to bring so that I can do this planning for you. It's not just a free consultation. I'm going to do a free comprehensive plan for you. In addition, when you come in to see me, I'll give you a copy of my book, 7 Steps to Financial Freedom in Retirement. Okay. Another break, and when we come back, we're going to get into, we've talked about all the negative things, and now we're going to get into the positive things of portfolio construction and how you can, in fact, put the market to work for you. All right, join me here. We'll be right back on the Retirement Report.